All right, it's recording, buddy. How you doing, man?
I'm good, man. How was your weekend?
Good, good. Pretty chill weekend, and didn't do much. What about you?
Went down to Charlottesville for a concert. Um,
I saw
my
that.
wife ended up getting kind of sick on Sunday. She had a migraine, so we just kind of chilled. So pretty quiet weekend overall. Probably did more work than I should have.
Do you go to the concert on Saturday or this
Saturday, yeah. We
Saturday?
drove
Okay.
down
So you
Saturday and
guys
then just
went back,
same
came
night.
back on Sunday.
No,
Cool,
no, we
cool.
just came
So
back same
listen,
night.
what's up?
We came back same night.
Okay. Oh! I thought you didn't. I thought you spent the night there.
Just down and up real quick.
That's like 2 hours. 2 hours away.
2 hour drive. Yeah, straight shot.
Okay.
Super easy.
Cool,
So
cool. So hey, listen, I wanted to talk to you about this program, DSCR loan. It's perfect for investors. You know more. Tell us what it is. What are the benefits? What's the requirements? What's the down payment and all the details? Go for it.
sure. Yeah. So simply put, DSCR is debt service coverage ratio program. What that means is that the property itself, the equity and the value of the property itself cover the cost of the mortgage. So basically what the property will rent for is calculated to be more or equal to the mortgage payment. So what the lender looks at, or what the investor looks at in that regard, is that they don't need as much or any sometimes documentation from the purchaser or from the borrower, because the property itself is worth it. So if you weren't to pay your mortgage, the investor would just take over the property, and the value of the property itself covers the risk. Obviously, nobody wants to not have their mortgage paid and have a situation like that. But in the eyes of the investor, the assumption of risk is a lot more minimal, knowing that the property has that value in place already. So it does have various qualification guidelines and parameters, most of which are what we call investor specific. So because it's considered a non-QM loan, non-qualified mortgage loan, so not your typical conventional VA or FHA loan, it's kind of at the whim of the guidelines and the overlays of the investor. So some go as low as requiring 25-30% down. Some are 20% down. There's a couple that go even as minimal as 15% down. And then again, the biggest factor is what we would call the DSCR ratio. And so the ratio is calculated based off of, again, the mortgage, and how much you can rent the property for. And so like a 1-to-1 ratio would be exactly, let's say the property rents for $2,000 a month, the mortgage plus all association fees, so principal, interest, taxes, insurance, and association, PITIA, is covered by that $2,000 a month on a 1-to-1 basis. Some programs require even more than that, 1.15% ratio, 1.25% ratio, and some offer better interest rates at better ratios.
Okay.
So some of them you can actually get a 0.75, which again, depending on the investor, I don't know why people would want to be a quarter into the red every month, but they do offer programs like that where the interest rate is going to be higher, because again, that's a higher risk for the investor, but those ratios can go down as low as like 0.75, 0.65, things like that. So
that's based on those interest rates. That's based on the how much the property can rent for.
correct.
So if the PITIA it's $1,500 and you can rent it for $2,000, you're in really good
It's a
position.
strong, yeah, that would be a strong program that you'd probably be in a pretty good position there. Now, again, you still have to have the assets for closing, the 20, 25, 15%, depending on the program, down, plus costs, plus the closing costs. But again, even some of these programs, for example, when we took yours and had to go conventional, only allows for 2% in interested party contributions, whereas DSCR can allow for it depends on the investor. Some of them up to 5%. Or maybe even more, again, depending on the investor. And that will allow you to buy down the interest rate, maybe put yourself in a good position. So, there's some nuance to it, like we've kind of experienced and I've experienced through the process of doing quite a few of these. There's some nuance to it. Some of them require reserves. The investor wants to see reserves to make sure that, again, that the first year you're not going to have a default. Some of them do have prepayment penalties.
Okay.
So, sometimes most of them, it's like a 3 or 5 year, you can pay out of those. So you can pay upfront additional costs to avoid prepayment penalties. Again, it's going to be super investor specific. Some of them require, some of them do not. Our in-house does not require it, but most of our brokered products do require some sort of prepayment penalty.
So the prepayment penalty, how does it work? So if I buy a property right now and next year I try to refinance it, I will have to pay a prepayment penalty because I'm paying off the mortgage early.
Yeah.
Is that just because, what's the purpose? Do you know what's the purpose of that? Are they just trying to save, I guess they just want to be sure that they're going to be making money for the next 5 years or 3 years? Are they
Yeah, well, I think that the purpose behind it is to avoid becoming the product for like fix and flips.
Okay.
Where you finance it, the numbers are good, but as soon as you flip it and now that, or once you fix it and now the numbers are, you can sell, flip it and you got that program and you basically did a hard money loan. They're kind of trying to avoid being that kind of program. So the idea is that, hey, if you're going to take advantage of this by not having to give us your tax returns or your income statements or any of these things, we want to at least make sure that you're invested in this as well, and you're not just going to turn around and put it over on us.
And then correct me if I'm wrong. If you are doing a DSCR loan and you are going to, let's say year 3, something happened, you decide the property has so much equity, you're like, I'm going to cash out, I'm going to go put it somewhere else. You only pay a percentage, right? Is that the percentage by year? Am I right on that, or?
Correct. Yeah. So it would be a sliding scale. So if it was a 3-year payment period, if you sold on the first year, the prepayment would be higher than if you sold on the second year or close to the third year. So yeah, it is based on a sliding scale typically. But yeah, it's, and again, you can usually pay out of it, but it's usually, pretty hefty upfront, points or, 1 to 3 points, I'd say, in fees that you're paying up front just to avoid that. So, again, this product is one of those that it's like, it makes sense for particular situations. It's not something that, if you can get into conventional, great. If you can get into FHA, if you're buying a multi-unit with FHA and you're going to live in one of the units, like that's still a really good program. The other thing though is like, again, if you are trying to take as much tax benefits as you can, and so your income doesn't look as high, and you're still trying to invest in real estate, this is a great thing for you. If you're just starting a business and you don't have the 2-year tax returns, and you're looking to invest in real estate, this is a great program for that. You say you're liquid heavy, but you're not income heavy. This is a great program for that.
So this program doesn't check your taxes and does not see your income. If your income is $100,000, but you only report $20,000, they don't care. As long as you have 20%, 25%, they're like, okay, and you have a couple months reserves. You're like, well, I know you said each program is different, but what's the minimum reserves you have to have? 6 months or 3 months?
Usually it's 6 months. Yeah, some of them require 12, but usually 6 months. And what I thought was really interesting is our in-house product. Because when you and I were talking, you were kind of like, if I go conventional, I need a minimum, I need reserves for all of my investment properties.
Right.
And with the DSCR program we're looking at, the reserves were only for the subject property. So we wouldn't even need to look at reserves for all of your other properties.
Right, because you said, 12 months. So and that's only movement, right? That's your only company.
That's our in-house product. Everybody has a DSCR program. They're all different. Like I said, we have probably a dozen other banks that we work with, that we broker the product through. But the in-house one is ours. It's actually Goldman Sachs is the investor. Fantastic program. I'm not sure who else has it. I'm sure a couple other people probably have it out there as well. But it's a very strong program, especially in the DSCR landscape.
Yeah, and that's why I wanted to talk to you about this, because it's like the program is so good. I mean, you looked at the other DSCR programs that you have that you guys offer, but it was like close to 10% interest rate. When you saw this in-house program, it's like 8%. So it's like 2% difference in interest rate. That adds up in a payment of $1,500. That's gonna be a couple $100 difference, which can make or break the deal if the numbers don't make sense. So okay, that's good stuff, man. But yeah, no, the what you're saying is, if you this type of loans make sense for somebody who already owns properties, somebody who their debt to income ratio is too high, or they already have they don't report as much taxes. Because somebody, if you're a first time home buyer, it doesn't make sense. It's nonsense, because you could buy a property with 3% down or 5% down, or you can do a what do you call it, the multi-unit. You do an FHA 3.5% down, you do a quadplex or a triplex, and then you live in one unit and then you rent out the other ones. And do they look at that income? Do you look at that income? Let's say it's a duplex, mortgage is $2,000, but you can rent that unit for $1,500. Do you consider that as income or no?
Yeah, that's
Okay.
that can be considered. Yeah.
Oh, that's pretty cool. So you just need to get a written lease, right? That's just be a regular FHA or conventional. And I know conventional.
Yeah, well, even with FHA, conventionals kind of changed the rules on that. We'd have to go back and look and see what their newest guidelines are on that. But with FHA, we take when we do the appraisal, we would take a rental comp of the units, and so you could apply the rent from.
So that would help you to qualify even if you were already stretching the numbers, but you get that $1,500 in. Let's say mortgage is $2,000. You're only looking at, I guess, 500 or 750 for the 75%.
Oh, I mean, if I could go back in time and I lived in an area that had multi-unit, man, that would have been the house hack of the century. If you're in college and you're renting out to your friends, to other college students, to and you just kind of expand your portfolio from there, and you basically have lived for free through college, qualified on minimal income, and got yourself started. Yeah, that is the way to go.
I was listening to this guy. You probably know, Bigger Pocket guy. I don't know if he's still the host, the podcast, and he was talking about house hacking. He was saying the same thing. He was like, "I've house hacked my whole life." He lives in Hawaii, $2.5 million property, and he says that he has a second home that is paying like half of his mortgage. Like the house in the back is paying half of his mortgage, and he's like, "Yeah, I don't have to do it, but I just do it because whatever." And a lot of people are afraid. They're like, "Yeah, I don't want. That sounds risky, because what if they don't pay?" It's like, well, most of the times that's what you're qualifying, right? You're qualifying to be able to buy by yourself. That just helps. And then you can put it in an account, and every month you get that rent, you just put it away and start saving it for the next down payment, for the next duplex. Or it's kind of this. Go ahead.
I was gonna say, just to your point, like, yeah, it's risky, sure, but so is everything else. The stock market could crash at any point. You put your cash in a mattress in your house, and the house could burn down. Like, there's risk to everything. If you want to invest, if you want to acquire wealth, you have to take some essential risks, and you just have to kind of minimize the risks that you're taking by taking advantage of opportunities in these markets. And real estate is one of those opportunities.
Yeah. So I'm gonna ask you the question, the $1 million question. Is now a good time to buy real estate?
I'm super bullish on it. I think now's a really good time to buy. If you're in a certain position, if you're investing in real estate, yes, it's a great time to buy. If you're a first-time home buyer, it's a great time to buy. The interest rates are high, yes, but if the interest rates come down with the amount of inventory that we have, demand is just going to go up, which means prices are going to go up, and buying a house is going to be harder. So if you're a first-time home buyer, if you're a veteran, you're taking advantage of VA, the VA is the easiest program to refinance. So get in now and as interest rates come down, you can refinance 2, 3, 4, 5 times with the VA IRRRL streamline refinance, usually zero to no costs, to little costs. So those three especially, I think I'm super big on. Investing is going to be harder. You've got Vanguard and Blackstone and BlackRock and everybody else trying to get in the game and investing tons of cash into the real estate right now. So it's going to be harder for us as investors to get in. It's going to be harder for first-time home buyers to get in. It's going to be harder for VA buyers to get in. If you're a family and you bought 3 years ago and you've got a really super low interest rate, yes, this might not be the best time for you. Like if you're happy and you're secure there, it has to make sense, right? The other people I really like too is, people that have bought 10, 12, 15 years ago and are sitting on a ton of equity. Now might be the best time to capitalize on that. Take care of that equity, get you into a position where you are in the house that you want or that you can repair and build up into something, and set yourself up for the long term. So I'm bullish on it. People are going to have their opinions. I'm sure some people are going to be like, no, the sky is falling.
I love Robert Kiyosaki. I mean, a lot of the stuff that I've listened, I've read his books, and I feel like I could see him like a mentor, but he's very, very negative when it comes to stuff like that. Because he's like, oh, the sky is falling, the sky is falling, the sky is falling. And if you're listening to him, he's like, oh, the sky is falling. So same with Peter Schiff. I think you follow him. It's always the sky is falling. And for me, it's like, I'm looking at the numbers, right? You're buying an investment property. You're like, okay, the interest rates are high. But once the moment the interest rates drop, I could easily refinance. And in 5 years, that property is going to be worth more than I'm already what I'm paying for. And somebody else is paying down my mortgage. I'm building equity on the property and hopefully appreciation. And I'm taking advantage of the taxes, the tax benefits, the depreciating and hopefully, well, the cash flow right now, it doesn't really make sense. I was talking to somebody this weekend and they're asking like, is now a good time to buy investments? And I'm saying, when the perfect market, something you got to give, right? There's 3 benefits: tax benefits, cash flow, and appreciation. And sometimes you have to give one of them, right? One of them, you're going to get the tax benefits. You might not get cash flow right now because you're buying, you're acquiring all the expenses, the down payment, and all the stuff, or appreciation. You got to see which one it makes more sense. If you're doing it for appreciation, then you're kind of betting against the market, right? You're betting against the market. And then, but if you want cash flow, it might not work. Like the unit that we're talking about, right? If this goes through, I'm only going to be making a couple $100. But I do know that in 2 years, the rent is going to go up. The rental market, if you look at the graph for the last 40 years, the rental market has been going like this. It's going to go up. The property is going to go appreciate in value. If once the interest rates come down next year, 2 years from now, I could easily just refinance. And at that point, I'm going to have more money in my pocket. So yeah, investing in real estate, especially if you're a first-time home buyers, it does not make sense for you not to buy. If you're renting, you should be buying real estate. So
yeah, if you're paying $2,000, $3,000, $2,500 a month in rent, you should be looking at what you could afford for a mortgage and where you would be, because that's a lot of money when you add it up over a 1 year, 5 year, tilt. Like it's a lot of money. It goes to somebody else. It's helping somebody else build wealth. It's not helping you build.
The way the lease was written before in Virginia, now it changed a little bit. But the way it was, you've seen a lease, right? You put the total amount. If the lease is for 2 years, you say, okay, $2,000 a month times 24, that's $44,000. And you put that amount. It's like, that's how much money you're going to pay to the landlord. It's like, that's a down payment. And so here's the thing too. I've seen that the rental, it might be a little bit cheaper to rent right now just because of the interest rates. If you're renting something for $2,000, if you want the same exact thing, you might have to pay a little bit more just because the interest rates are high. But in 3 years, in 5 years, it's going to be harder for you to buy a property than it is now, because that property is going to appreciate in value. sure, you're saving right now, you're saving $300 instead of getting a mortgage, but long term is definitely gonna hurt you. So
Yeah. Well, and if you look at it this way too, where it's like, let's say you're paying $2,200 in rent a month, right, for a 2-bedroom apartment in Fairfax County or something like that, Loudoun County. And you can qualify and get into a $3,300 mortgage, right? $1,100 more, but it gets you into a 3-bedroom condo or townhouse, right? About a quarter of that payment, that $3,300, is immediately going to principal. So it's immediately going to you, right? So if you take that, quarter of it out, so you're saying, say $600 a month is going towards principal. So you subtract that from your 3,300. Now you're at 2,700. So now you're only paying $600 more to own a house that's appreciating, and not, and yes, that is more of a upfront, day-to-day, month-to-month cost, but the investment that you're putting into yourself and into the appreciation of real estate is going to, again, even if it's just 5 years, on that 5-year tilt, we can show you that it's going to make you money. It's going to make you money as opposed to just losing money.
And this goes back to what we were saying. If you think that's really expensive, house hack, get some roommates, man. It's a small sacrifice, but it's helping you build wealth, and in the long term, you're gonna be good. So okay, well, thanks, man. Appreciate it. This was good. How can people find you? What's the best way to connect with you if somebody is thinking about, oh my gosh, I just need to apply. I like Glendon's beer, so I need to work with this guy.
Yeah, I'm probably one of the easiest people you'll ever be able to find. Glendon is a very unique name, so you really just got to Google my name, Glendon Grose, and I pop right up. But also, my website is glendongrose.com.
Okay.
Grose, glendongrose.com. Instagram, Facebook, I'm all over wherever I can be. I haven't traversed to Twitter or anything, and it's at TikTok yet, but someday.
TikTok and Twitter is now X.
Yeah. I haven't gotten onto those platforms yet, but maybe next year.
All right, cool, man. Thanks for joining me and doing this. That was cool. So definitely, we're gonna be in contact, and I'm gonna put all your information in the YouTube.
Excited, man. Thanks, bud.
You got it, buddy.